Learning Module, Analyzing Balance Sheets. Topic: Intangible Assets. A technology company incurs the following costs for an internal project: $80,000 for initial exploratory research and $150,000 for detailed product design after achieving technological feasibility. Under IFRS, what is the total amount that can be capitalized as an intangible asset? A. $0. B. $150,000. C. $230,000. Research phase costs, like the $80,000 exploratory research, must be expensed under IFRS, not capitalized. Development phase costs, like the $150,000 detailed product design after technological feasibility, can be capitalized under IFRS if criteria are met. A. $0 reflects U.S. GAAP treatment, all expensed, not IFRS. C. $230,000 wrongly includes research costs, which IFRS explicitly requires to be expensed. Topic: Goodwill. An analyst is comparing three firms and notes their goodwill as a percentage of total assets. Firm P, 1.2%. Firm Q, 0.5%. Firm R, 32.5%. Which firm has most likely used acquisitions as its primary growth strategy? Firm P, B. Firm Q, C. Firm R. The initial calculation of goodwill in a business combination is the excess of the purchase price over the A. Book value of the acquiree's net assets. B. Fair value of the acquiree's net identifiable assets. C. Fair value of the acquirer's net assets. Under both IFRS and U.S. GAAP, how is accounting goodwill from a business combination treated in the years following the acquisition? A. It is amortized on a straight-line basis over its estimated useful life. B. It is tested for impairment at least annually. C. It is expensed immediately in the period of acquisition. Firm R's 32.5% goodwill signals heavy reliance on acquisitions, since goodwill arises when purchase price exceeds fair value of net assets. Firms P, 1.2%, and Q, 0.5%, show minimal goodwill, meaning little acquisition activity and growth driven mainly by organic strategies. Goodwill is calculated as purchase price, minus the fair value of the acquiree's net identifiable assets. This captures intangible factors like brand reputation and synergies. A. Book value is wrong because goodwill uses fair value, not historical cost. C. Fair value of acquirer's net assets is irrelevant since goodwill relates only to the acquiree's assets and liabilities. Goodwill is not amortized. Instead, it must be tested for impairment annually under both IFRS and U.S. GAAP. This reflects its indefinite useful life. A. Amortization is wrong because amortization applies only to finite-lived intangibles, not goodwill. C. Expensed immediately is wrong because goodwill is recognized as an intangible asset at acquisition, not written off right away. Topic: Financial instruments. For financial assets classified as trading securities, where are the unrealized holding gains and losses reported? A. They are not recognized in the financial statements. B. They are reported as a direct adjustment to paid-in capital. C. They are reported on the income statement. A company holds a portfolio of debt securities classified as available for sale. At year-end, the portfolio has an unrealized loss. This loss will be reflected in A. The income statement reducing net income. B. Retained earnings on the balance sheet. C. Accumulated other comprehensive income within shareholders' equity. A company's investment in a long-term corporate bond is classified as held to maturity. At the end of the reporting period, the bond's market value has increased. How is this increase reflected in the financial statements? A. It is recognized as an unrealized gain in other comprehensive income. B. It is recognized as an unrealized gain on the income statement. C. It is not recognized in the financial statements. Trading securities are measured at fair value through profit or loss. So unrealized gains and losses are reported on the income statement, under both IFRS and US GAAP. A. Not recognized is wrong because unrealized gains losses for trading securities must be recognized. B. Adjustment to paid-in capital is wrong because equity adjustments apply to FVOCI available for sale securities, not trading securities. Unrealized gain or losses on available for sale, or AFS debt securities, are recorded in other comprehensive income, or OCI, and accumulated in equity as AOCI, not in net income. A. Income statement applies to trading securities, not AFS. B. Retained earnings is incorrect because unrealized OCI items bypass net income and therefore do not affect retained earnings directly. Held to maturity, our HTM securities are measured at amortized cost, so changes in market value, like the increase here, are not recognized in the financial statements. Gains or losses are only recognized when sold or at maturity. A. OCI recognition applies to available for sale securities, AFS or FVOCI, not HTM. B. Income statement recognition applies to trading securities, FVTPL, not HTM. Topic: Non-current liabilities. A company reports higher depreciation expense for tax purposes than for its financial statements in the current period. This difference will most likely result in A. Deferred tax asset. B. Deferred tax liability. C. Permanent tax difference with no deferred tax consequence. When tax depreciation is greater than accounting depreciation, taxable income is lower now, but will be higher later, creating a temporary difference. This leads to a deferred tax liability, since the company will owe more taxes in the future when the difference reverses. A. Deferred tax asset is wrong because that arises when taxable income is higher than accounting income. C. Permanent difference is wrong because depreciation timing differences are temporary and do reverse, unlike permanent differences. Topic: Ratios and common size analysis. All of the following are classified as current assets on a balance sheet except A. Accounts receivable. B. Property, plant, and equipment. C. Short-term marketable securities. A company reports total liabilities of $20 million and total equity of $30 million. On a vertical common size balance sheet, total equity would be represented by a percentage closest to 40%, B. 60%, C. 67%. Which of the following questions can be answered most directly by analyzing a vertical common size balance sheet? Has the company become more profitable? B. Is the company collecting its receivables faster? C. Has the company shifted its financing toward more debt? A company records a significant impairment charge on its property, plant, and equipment. All else equal, the immediate effect of this charge is most likely to A. Decrease the company's total asset turnover. B. Increase the company's financial leverage ratio. C. Increase the company's current ratio. An analyst is evaluating a company's ability to pay its bills that are due within the next 12 months. The analyst is most likely to examine the company's A. Current ratio. B. Debt to equity ratio. C. Return on assets. Which liquidity ratio provides the most conservative assessment by excluding accounts receivable from its calculation? A. Current ratio. B. Quick ratio. C. Cash ratio. A bondholder is most concerned with a company's ability to meet its interest and principal payments over the life of the bond. This investor should primarily analyze the company's A. Liquidity ratios. B. Solvency ratios. C. Profitability ratios. A company's common-size balance sheet shows goodwill, representing 22% of total assets, while the industry average is 5%. This difference most likely indicates that the company has a lower level of financial leverage than its peers. B. Has higher liquidity risk than its peers. C. Has grown more through acquisitions than its peers. A company's common-size balance sheet shows the following: cash, 8%, marketable securities, 4%, accounts receivable, 12%, inventory, 18%, and total current liabilities, 30%. The company's quick ratio is closest to A. 0.24, B. 0.80, C. 1.40. A company's common-size balance sheet shows total assets of 100% and total equity of 40%. The company's financial leverage ratio is closest to A. 0.40, B. 1.50, C. 2.50. An analyst is comparing two firms using their common-size balance sheets. Firm 1, cash, 10%, marketable securities, 5%, accounts receivable, 15%, inventory, 25%. Current liabilities, 40%. Firm 2, cash, 6%, marketable securities, 2%, accounts receivable, 20%, inventory, 30%. Current liabilities, 35%. Which firm has a higher cash ratio, indicating lower immediate liquidity risk? A. Firm 1. B. Firm 2. C. Both have the same cash ratio. An analyst collects the following data for three firms in $millions. Firm X, inventory equals 50, total assets equals 400. Firm Y, inventory equals 80, total assets equals 1,000. Firm Z, inventory equals 60, total assets equals 500. Using vertical common size analysis, which firm has the highest inventory as a percentage of total assets? A. Firm X, B. Firm Y, C. Firm Z. Property, plant, and equipment, PP&E, are long-term, non-current assets used over multiple periods, not expected to be converted into cash within 1 year. A. Accounts receivable are current assets because they are collectible within a year. C. Short-term marketable securities are current assets because they can be quickly converted into cash. A vertical common-size balance sheet expresses each item as a percentage of total assets. Total assets equals 50 million. Equity percentage equals 60%. A. 40% represents liabilities, not equity. C. 67% is a miscalculation, likely from dividing equity by liabilities instead of total assets. A vertical common-size balance sheet shows each item as a percentage of total assets, making it useful for analyzing the financing mix. Changes in the proportion of liabilities versus equity directly reveal whether the company has shifted toward more debt financing. A. Profitability is wrong because profitability is measured using the income statement, not the balance sheet. B. Receivables collection speed is wrong because receivables turnover requires both income statement and balance sheet data, not just a common-size balance sheet. An impairment charge reduces the carrying value of PP&E, which lowers total assets and equity. Since liabilities remain unchanged, the financial leverage ratio increases because equity decreases relative to debt. A decrease in asset turnover is wrong because lower assets with unchanged revenue actually increase asset turnover. C. Increase in current ratio is wrong because the impairment affects non-current assets, not current assets or liabilities. The current ratio, current assets divided by current liabilities, directly measures a company's ability to pay bills due within the next 12 months, making it the most relevant liquidity ratio for short-term obligations. B. Debt-to-equity ratio is a solvency ratio focused on long-term capital structure, not short-term liquidity. C. Return on assets is a profitability ratio, measuring efficiency in generating profit from assets, not the ability to cover short-term bills. The cash ratio is the most conservative, stringent liquidity ratio because its numerator includes cash, cash equivalents, and marketable securities, while specifically excluding accounts receivable, inventory, and other less liquid current assets. A. Current ratio is least conservative since it includes all current assets, even less liquid ones like inventory and prepaid expenses. B. Quick ratio is more conservative than the current ratio, but still includes accounts receivable, so it does not fully meet the criterion. Solvency ratios directly measure a company's ability to meet long-term debt obligations, including interest and principal payments. This makes them the most relevant for bondholders concerned with creditworthiness over the bond's life. Illiquidity ratios focus on short-term obligations, not long-term debt repayment. See, profitability ratios measure efficiency and earnings, but do not directly assess the ability to repay debt. Goodwill arises from acquisitions and a much higher goodwill percentage. 22% versus 5% industry average indicates the company has relied more on growth through acquisitions rather than organic growth. A. Lower financial leverage is wrong because goodwill is an asset and does not directly relate to debt levels or leverage. B. Higher liquidity risk is wrong because goodwill is a non-current intangible asset and does not directly affect liquidity ratios. The quick ratio excludes inventory but includes cash, marketable securities, and accounts receivable. Using the percentages given, cash 8% plus marketable securities 4% plus accounts receivable 12% equals 24%. Dividing by current liabilities 30% gives 0.80. The calculation shows how in a common-size balance sheet, both numerator and denominator are expressed as percentages of total assets, so the ratio can be computed directly. Inventory is excluded because the quick ratio focuses only on the most liquid assets. The financial leverage ratio is calculated as total assets divided by total equity. A ratio above 1 indicates debt usage. A ratio of 2.50 means the company finances 60% of its assets, with debt and 40% with equity. The cash ratio measures immediate liquidity, using only cash and marketable securities, compared to current liabilities. Vertical common size analysis expresses inventory as a percentage of total assets, allowing comparison across firms of different sizes. Firm X has the highest inventory percentage, 12.5%.